Okay. Hi, everyone, and welcome to this webinar. As usual, my pleasure to be here with you all, guys. The Beginner's Corner's idea is to meet different expert views of the forex market. And today we are going to share a bit of what Greg taught us a couple of weeks ago with his trees growth strategy. I always say that as simple as better, and I believe that this is a strategy that fits that because it's a very simple one, right? It does not involve too much technical analysis or technical indicators, and however, seems to be quite profitable. I have tested myself over the years, okay, and I found that this is a pretty reliable one. Anyway, needing to review a bit the concept of the strategy, how to set it up, and some tips about the trading development, okay? Anyway, you know that this Greg Michalowski's risk across strategy is based on the idea that a strategy should also define risk, right? Not only giving you a buying or a selling signal, but add the risk to the equation. As an example, he said that when we are trading with moving average, most technical analysts focus on the moving average crossover, right? For example, when short-term moving averages crosses over a long-term one, it changed the bias from bearish to bullish, creating a buy signal, right? The problem with this strategy is that this does not necessarily define risk. So he added a third dimension that gives trader a bullish or bearish bias and also defines risk. I found that to be pretty interesting. Anyway, the idea of this setup for the trees across that is named after the old adage about love to the company and trees across. He gave us pretty funny examples with Brad Pitt, Angelina Jolie, etc. The idea is that this trading definition is that the two moving average represents the couple, right? And the price is the third wheel that needs to wait, and usually does, because moving averages tend to lag, right? That's why price is the first to move. So when we have a certain setup, right, where the two moving averages converge with price, right, we should expect the price to move away. That's the base of the strategy, okay? So up to now, the setup is as follows: a 100 moving average, a 200 moving average, and price, okay? Just with these three tools, the strategy is able to anticipate a trade, a probable market movement, yet also help us minimize the risk involved, right? So let's see a bit how this works, okay? How to get into the market. What we are looking for, okay, as I said, is a situation where the 100 and the 200 moving averages and the price all converge to form the trees that crowd set up, right? So now that the setup is ready, we may anticipate market moves, okay? Assuming a break higher, okay, it doesn't have to be higher, it could be higher or lower. It's not what we are looking for. We are looking for confirmation after that, right? The trader goes long and initially can use the 100 and the 200 moving average as points for stop-loss orders, right? I made a small example here in a pound-dollar 5-minute chart, okay? As you can see, we have a situation in here that could be understood as a trees across situation. Why? Because price, 100 and 200 moving average come together in a small difference of, in this particular case, 6-7 pips, right? Greg also taught us that it does not have to be exactly, right? It could be a couple of pips difference accordingly to the chart you are looking for. If you're looking at 1 hour chart, it could be a bit more than 5 or 6 pips, yet not much more. However, in this particular case, right, so in here, right, there is a small difference of where the price and the moving averages are located. Of course, what we are seeing in this particular chart, and I want to stop a bit around here, right, is that we have the moving averages coming together, price also coming together to the area, and the break higher, then a break lower, then another break higher, and finally a break lower. So the the thing here, usual with any kind of trading strategy or with any kind of setup is when, right? When do I get into the market? Okay, we are going to get to that in a few, okay? But that's the particular setup we are looking for, okay? As I was saying, if the price breaks higher, we understand that that's bullish signal, and the price will continue higher. And if we have the setup and price breaks lower, we have a bearish setup and the price will fall. Okay. The idea is like, as I was saying, there are a couple of tips to filter these noisy movements up and down, up and down, up and down. The idea is to look for a break to confirm the directional bias for a trend like move away. Okay. So we need a clear break of the moving average. Okay. Also, when the price moves above the 100 moving average, we should start understanding that as buying signal, okay, or selling below. Therefore, a target would be then the 200 simple moving average, and Greg called this the confirming moving average, as it confirms the trend. Why? Because usually the 200 simple moving average is a harder one to break, okay? You know, he also explained that he uses the two moving average, 100 and 200, right? Because all the market, all the traders are looking at this particular one. So for trading Forex, he says that it's the best setup, and I agree with him. We are all looking at the behavior of the price of every pair against its 100 simple moving average and against 200 simple moving average. What we are not looking for is for this setup or this particular strategy, right? Anyway, the idea is that as moving average distance narrows, right, and starts converging, they are telling us that the market is entering a consolidated stage, and at some point will develop a trend, right? The problem is always when. But on the contrary, as long as price is in the trend, the moving average distance will widen, wider, okay? As I told you, the 201 is the harder to break. And what is also interesting about this is that the trending market, okay, at some point transitions into a non-trending market, right? That's the time to wait and see, okay? That is the time we have to wait for the setup to complete. I believe that among the hardest thing we have to face as traders is to be patient, right? If we take a look these days at euro dollar or pound, not pound, euro dollar or Swiss daily charts, we will find a strong lack of trend, right? In the big time frames, we are in a non-trending market with euro dollar trading in a 300 pips range for already a couple of months. Okay. However, at some point, this non-trending market will actually transition into a trending one, right? As I said, the problem is the usual when, okay? And the idea is that this strategy may help us determine that by using the moving average, okay? The idea to trade with this, and we are going to see some practical examples right now, is to filter entries with static support and resistance levels and trend lines, okay? To filter that noise we have seen in the chart where we have price breaking up and down the 100 and the 200, okay? How do I know when to get into the market? How do I know how to control that noisy movement and be sure that the setup is ready to confirm a trend? Well, the use of support, static support and resistance levels and trend lines is what favors most, or fits more, with this kind of strategy. I find out that the strategy can be applied to the daily chart, to the 1 hour chart, or to the 5-minute chart. However, I find out that there is not plenty of setups in the 4-hour chart, and also it's a bit more noisy, believe it or not, than the 1 hour one, okay? Anyway, the idea of managing the trade, right, is that the market moves in the expected direction. Corrective movements can and should be expected. That works not only for this particular setup, but for any setup. If there is something that we know is that the trend never goes straight and we always have corrections in the middle. So how do I know if this particular trend is over, okay, or I'm witnessing just a corrective movement against that trend? Well, Greg told us to use Fibonacci levels to partially profit on retracement and protect our gain, right? Yet also control the trade and see if we are actually seeing a correction or if the trend is over. To the same 5-minute chart we have seen a couple of minutes ago, right? Okay, as we can see, and according to what Greg said, the idea of adding a Fibonacci retracement, right? It seems quite great. Sorry, the Fibonacci should be here. Okay, I changed it in the last minute, but it should be here. Anyway, if the market moves in the direction, as we can see here, right? A corrective movement, okay, towards 38.2%, like we are seeing in this first case, in this first candles around here, is logical and probable, right? We have the downside and the corrective movement, okay? He says that he usually takes partial profits, 1/3 of 1/2 of his trade, depending on the strategy, right, to protect his gain. Of course, the next key corrective level to pay attention is the 50% retracement of the rally, right? Just like the 38.2, if the price stays above the line, okay, look for rotation back to the upside and to the option and to the downside in this particular case with an extension to new lows, okay? If the price, on contrary, breaks above a 50% retracement in this case, the last another part of the trade could be closed, okay, another third, and of course the final line will be the 61.8% retrace, okay. If the price holds the 61.8, the ADA standard width will finally resume. However, if it breaks higher, okay, it's telling us there is a chance of the reverse into the bearish trend. Anyway, in fact, you are ensuring some of your profits with the different Fibonacci levels, right? And protecting from the market noise or the market movement, right? And I believe that we all know how to use this, so they are pretty simple, and we are going to see some live examples right now, okay? But as a conclusion of this theoretical situation, right, I would like to add something of myself, okay? As always, the trading strategy isn't complete without some criteria, right? There is no perfect combination of indicators. There is no holy grail. All of these trading strategies need some thoughts of our own and some analysis. We are going to do some right now, and we are going to see how we manage risk with this strategy, okay? But keep in mind that all trades need to stop in the target area, okay? We need to confirm the break, okay, and know where is our risk. We have to ask ourselves when we get into the trade, is our risk limit is defined? I know how much I can lose with this position. If the answer is yes, and the loss, the probable loss is logical, then I can trade the trade. If the risk is not defined, if the risk is not limited, if I don't know how much I can lose, I'm in trouble and I cannot take that trade, right? That's the terrible risk of trading without stop loss, okay? Another thing that a strategy should include, okay, is know your potential profits. Have an idea of how much money you can make. We are going to go to the practice and see some of these, okay? And as the Fibonacci told us, we have to revalue the strategy and the trade as the trade develops, okay? Mostly if we are short-term traders, okay? If we are longer-term traders, I do believe that we have a wider window to control and revalue the strategy, right? But if a retracement moves away from our 38.2% Fibonacci, we should be aware that there's a possibility of the beginning of a stronger movement against our trade, right? So it's time to profit some. It's time to ensure our capital. Remember, as traders, the first thing we need to do is protect our capital, and the second one, okay, is win. Okay, the first one is protect your capital. The second one is win. Okay. Anyway, I will make a brief interruption to the video. We are going. Okay. We are going. Hi, Connie says, can you show us an example of how to protect your profits with Fibonacci retracement? Yes, I believe that we have seen it, but I will open my charts and we are going to see some practical examples of this. Anyway, if you have any questions or comments, would be a great time to post them. Sorry for that noise. Okay, give me a second. Okay, here we are. With a little chart. Okay, I have prepared a couple of little charts to show you. As you can see, I have chosen 5-minute charts, right? Because the setup is a bit faster here. We see the setup quite close to it. Okay, and I believe that among me, OC is the one that works better with this strategy. I have tested myself for a couple of months and I found it pretty reliable. Anyway, this is Australian dollar against American dollar 5-minute chart. Okay, and as you can see, right, we have the setup with a report, probably with a technical report, right, that requires a bit of our analysis. In between the two moving average, we have less than 7 pips, right, and the price breaks below the 100, right, and then later below the 200 one. Okay, breaking below the 200, being the 201, the topper one, is the first signal that the bearish trend will start developing, right? Next, what we see in here, the next candle offers a pullback, right? And if you take a look at static support level, in here we have a strong one around 100, or usually round numbers are great for commodity currencies, right? We see that the pair starts consolidating below. So what we are seeing here is that the bearish trend starts developing, right? Do I know my risk when I get into the trade around 100? Yes, because my first stop will be, note that my first warning of risk will be 420, right? Which is the first moving average. In this particular case, as we are working a 5-minute chart, right? And having the 101 at 5 pips above to 425, right? What do I know? Well, I know that if price overcomes back 426 in this particular case, right? The setup or the trading strategy has failed, right? And I have to leave my trade. So I have to risk 25 pips in this particular trade, right? However, the idea of a crowd trading strategy is to try to catch the trend from the beginning and see how it develops, right? And follow all the trends when it develops, okay? So as price continues falling, right? And the moving average distance in between each other widens, right? As we can see in here, okay, we'll come together, we are widening. Why? No, I am on the right side of the market, okay? As long as I'm bearish and the moving average is above current price and the distance in between moving average widens, I'm in the right side of the market. In this particular case, I love this setup because an Australian dollar, because you can see how the 100 moving average is starting to act as a resistance level, right? Price breaks above it. What should I do here? In this particular moment when price breaks here, first I will profit some, okay? And second, I will place my stop in the 400 area, which was my entry level. Why? Because that's where the 200 moving average, okay? And I know that if price overcomes this second moving average, okay, the trade will be lost and the setup will be changed. So, as I was said, keep in mind this, that if you have a certain combination of indicators, certain setup, that gives you a market entry, right, with a couple of conditions, okay? If one of those conditions is lost, right, the setup is lost, so the trade is failing, starting to fail. Okay, that's the time when I have to take a decision, act, and protect my trade and my capital. Anyway, the price failed to continue higher. The price break below back of the 100, and as you can see, the market continued falling. Which I found interesting of this particular case, I was moving slowly, is that we see that the distance is still wide, the price is still below the 100, right? And in a certain moment, of course, that trend will change, okay? And of course, it will start rising. Look where its price halted, right? It halted at the 200, not just once, but twice. And what happened next with the market? The distance in between the two moving average starts to shrink, okay? And the strong bearish slope moving average turns to no slope, turns to flat moving average. What is this telling me? All this situation in here, okay? So I know it's a big situation, but remember we are talking about 5-minute charts in here, so it's actually a couple of hours, okay? What's going on in here, okay? In here, the market is telling me that the bearish trend is done and that we are entering in a sideways market. And when we enter in a sideways market, what can happen? Anything can happen, right? We need to wait for next time. It's time to go, time to leave. We are trading in the 140, 160 range, meaning 130 pips away from the entry point, okay? So if we have profit 1/3 in the first part and another third around here, right, and move the stop right above the 200, okay, we still have 1/3 of our trade to profit around this area. But that's the end of the trade, right? That's what I like to remark. We need to, as I said at the conclusion, right? We need to think, okay? There is no mathematical formula to trade automatically without some analysis of our own, okay? Mostly in this particular setup. Anyway, as I told you also, the market was trendy and now we enter into a transition stage, right? Time to close and wait for a new setup. In this particular case, I have a setup, okay? See the both moving average price breaks below the 100, then breaks below 200, and we have barely 2 pips difference in between both with price, okay? So we have a bearish trade, but it only gives us a couple of pips. Let's measure it 10 pips before price starts recovering back up and sets a bullish trend, right? So how do I understand this? How do I filter this kind of situation? As I said, the best thing I believe is to wait either for a break of a trend line, okay, or wait for Fibonacci retracement, or watch the Fibonacci. Also, wait for a break below a static support or resistance level before taking the break, the trade. So we confirm the break. If we draw in here sort of static support area, see we have price halting there a bit below several times in this particular chart, we can see the price was unable to break that support. I myself hardly recommend you to set your support and resistance level in bigger time frames, 1 hour, 4 hours if you are attempting to trade in the 5-minute chart. And the setup of the support and resistance levels should be the first thing to do before looking even for a setup. So you cannot cheat yourself, okay, about where support and resistance levels are. Start setting up support and resistance levels in the 1 hour and the 4 hour chart, where you can see the price has halted several times among the last couple of weeks. Give more weight to the ones that happened in the last couple of weeks that happened in the past, okay? Also, you can consider when you're determining those static support levels, weekly or monthly highs. In fact, if you take a look at pound dollar, we have October high from past year. Today's high 160, 165 or so, and we have their strong resistance area, okay, and of course price wasn't able to break above it, okay, at least in this first attempt. Of course, keep in mind that there's no invincible, okay, support or resistance level. At some point it will be broken, okay, so either that or a trend line. And about the question concept about using Fibonacci retracement, sorry, I will, okay, using Fibonacci retracement, okay, let me find the place back. Okay, sorry for that. Okay, where is it? I love it. Okay, give me a second, sorry. I lost my setup. Okay, we can use anyone anyway. Okay, it's not the same case, but we have several cases in here, okay, with the same. So, Greg was trying to tell us about the Fibonacci retracements, right? In this particular case, the break starts here, right? But if I have to set a Fibonacci, I will take a relevant low, right, like this particular one, okay, before taking my profits, right? I will wait for a high to be set above the previous one, okay, and then I will draw my Fibonacci. So the price after the break, the first retracement to the 38 level was here, right? So maybe that is your time to take 1/3 of your profit. In the next candle, we have a retracement to the 50%, and it's time to take the second one, right? What I'm seeing in this particular case is that moving average, as you can see in the main flat, right? The third chart could be taken at the 61, but in the fact price did not break below and regain the upside, right? That's the way you use the Fibonacci retracement, okay, for determining where you to take your profit. I will also remind you all that any trade can be taken either against or following dominant trend, but see what is going on with the Australian dollar in the smaller time frames. The upward movements are very limited compared to bearish one. Why? Because the dominant trend is in this particular pair strongly bearish since Governor Glenn Stevens suggests they are going to cut rates, right? In that coming meeting. Anyway, in this particular case, we have a bearish setup. The break of the support area around 357, okay, is our trigger to get into the trade. Okay, the maximum the pair falls in this particular case was 310, and we have in here 339 or 340, okay, to profit our first asset. However, as you can see, price wasn't able to to break above 50, right, and the price continues to go. So I would say that I would finally take all my profits around this area when the price breaks above the 100, and we have candle opening above it. Greg also added that when price breaks the 100, it will usually tend to the 200, right? But again, the 200 is the strongest one, and it's not an easy breaking one. Okay, so as you can see again, the price takes here. I don't know. I believe that this is the part where your discretion is needed, right? You can stay into a trade, you can profit, you can wait for price to reach 200. Okay, and as long as below the 200, bearish setup continues. In fact, as you can see, moving average quickly start to turn back flat. Okay, and as long as the both stay flat and price hovers around there, there's not a clear setup. And again, the trades go to the upside and the trades go to the downside. We have this mixed situation that's telling us that the market is static. In the 5-minute charts, of course, the profits will be small, but they are there if you wait for the break of the trend line or the static support. And sometimes, of course, happens this or the trend is very strong. Okay, But the idea of this trading setup is that you know, you also know the risk. Remember the risk factor that it is associated here. No matter how much trades you take in this case to the upside, to downside, to the upside, to downside, you know in every single case how much you're risking and where to place yourself. Okay? So I believe that that's really interesting because in this particular case, the pair is bullish, a break of the 100, and then for the 200 is in, and then the 100 is still got some bearish pressure, right? And regardless the short this rally art, because we are working on the 5-minute chart, a retracement of the 38 below the 38.2% is telling you that it's time to leave. Okay. And on the contrary, okay, when the upside starts, the rally starts strongly, moving average starts gaining slope, right, losing this flatness, okay, and the distance widens. Again, you are in the right side of the market, okay, until a break of the 200. I love the Australian dollar in particular because it respects a lot, okay, the 200 and the 100 moving average as dynamic support and resistance levels, and therefore the breaks are clearer. You can also work with the pullbacks in this case, and the one we have seen earlier, right, to confirm the technical break beyond the static support or resistance area. Okay. Anyway, sorry. Okay. Okay. Connie says I would hate to lose 61.8% of my profit. True. We all will hate it. My particular point of view, not related to, not something that Greg has said, okay, but my particular point of view is that usually the amount of pips we can profit from a trade, right, are strongly related to the trade time frame we are trading. If you are trading a 5-minute time frame, right, you cannot expect to win much more than what 100 pips in the case you catch a trend. Okay, that's the daily movements of the pair. Seems way too much. Maybe 50 seems more logical, right? But what you can also try to do is follow bigger time frames and see the 100 and the 200 as dynamic support or resistance levels. What I'm seeing here in the Australian dollar in particular is that despite we have no technical signals right now, right? The trend is clearly bearish. So if I have to take a trade, it will be to the downside. I won't be buying this particular thing, right? At this point, yes, not time to buy. So watch the 4-hour chart and determine the trend here. If we have a trend, try to follow the signals that go favoring that trend, okay? And what I'm also seeing in this particular case is that moving average are starting to lose their slope, right? They're very slow and they're turning flat, and prices struggling around the 101, and it aims to break, okay? So unless a break of the 200, there is no reason to go bullish with this particular strategy in Australian dollar against the green, okay? So if I have to trade a 5-minute chart of the 1-hour chart with this strategy, okay, I will try to go for the selling rallies. And if we change to the 1-hour chart, right, you will see that in fact bearish signals we have are much stronger than the bullish one that provide us with less than 20 pips profits, right? Or to downside, it seems to be always a much more interesting move, right? So that's the part where I said we need to add some logic to our trading, right? And some follow through despite the entry point stop and limit. Okay? So if you're trading 1-hour charts and you're following the trade, it's more easy to pretend to win 100 pips, okay, than if you're trading in the 5-minute charts against the trend, right? So those are the kind of things that apply not only to this strategy, but to any trading strategy, okay? Another thing that I want to add before I forget is the fact that when we are trading 1 hour, the 5-minute chart, usually all the brokers show the same formations, right? The moving average will be pretty close. Won't be clear, less or more, but not much different. However, when you change to the flow chart or even to the daily chart, right? Different brokers expecting different time zones, and that will make candles look different, close different, open different, right? And that will change the place of the moving averages, right? The 100 could be in the daily chart, I don't know, in 320, and in another chart could be at 340, okay? It's not weird to see 20, 50 pips difference of where the moving average is located if you compare different brokers from different time zones, right? So no matter what, regardless, this is a great strategy. Test it, okay, and follow it before applying it. Live in a real account, okay? Anyway, sorry again. I don't know if you have any other questions, comments. The fact is that it's always the same, right? It's not the tool we use, but how we use it. There's no much difference in between this trading strategy and another trading strategy that may prefer a moving average crosses, like we saw with Raghi a couple of months ago, Raghi Horner. Okay, she also shared some of his strategy with us here at the Beginner's Corner. Okay, so it's not one strategy is better than the other, right? It's how the developer and the trader learns to use that strategy that makes it work, okay? And some logic discretion from the trader, okay? Okay, I have talked too much and too fast as usual. Anyway, do you have any idea, question? Really, I would like, would love to hear your comments about this strategy, okay? No questions, no comments, nothing? Thank you, Connie. I do believe it's great. I do believe this is a great strategy. So I believe it works that's right, mostly for beginners. Really. Okay, so if we have no more questions or nothing to add, I would like to thank you all for being here. Okay, and hopefully we'll be back again soon with another webinar. Thanks all. I hope I helped you a bit and see you back soon, okay? Bye-bye. Thank you all, really.